Hey everyone, welcome back to The Explainer. I am absolutely thrilled to have you here today. It's May 30th, 2026, and honestly, we're watching something truly historic unfold in the digital asset space right now. We are officially seeing the cryptocurrency market transition completely out of its experimental adolescence into a brand new phase. I like to call this the era of mechanical and legal maturity. Today, we're going to dive into a new generation of AI agent capabilities, some massive shifts in how miners are operating, and a really significant regulatory pivot aimed at protecting holders from both physical and multinational fraud. We've got a lot of ground to cover. Okay, so here's our roadmap for today. First up, the AI agent economy. Number 2, miners pivot to AI. 3, hedging and digital scarcity. 4th, closing the Wild West. And we'll wrap it all up with the AI beta rally. Section 1, the AI agent economy. To really get a handle on this, we kind of need to zoom out a bit and look broadly at the massive integration of artificial intelligence going directly into cryptocurrency protocols. We aren't just talking about chatbots generating code anymore. We are talking about what's known as agentic workflows. Literally just hours ago, Anthropic debuted Claude Opus 4.7, and this isn't your standard update. This specific model is heavily optimized for these exact agentic workflows, drastically lowering the friction for machine-led financial operations. We're looking at a reality, starting today, where AI agents are managing incredibly complex, multi-step, on-chain financial operations completely without human intervention. The machine itself is literally becoming the market participant. And you have to wrap your head around the awe-inspiring scale of this. $28 trillion, that's a T, trillion. That is the staggering amount of volume flowing through crypto's agent economy. But context is everything, right? Right now, data shows that about 76% of this volume is basically just simple bots endlessly playing ping pong with stablecoins back and forth. But that is exactly why the launch of Claude Opus 4.7 is such a game changer for us. We're moving from those simple, pre-programmed bots to dynamic, reasoning AI agents. The infrastructure is there, the volume is already massive, and now the real intelligence is coming online. Moving on to Section 2, miners pivot to AI. So while AI agents are completely taking over the software layer, the physical infrastructure layer is going through a massive transformation of its own. Back in the first quarter of 2026, the mining giant Riot Platforms disclosed that they sold 3,778 Bitcoin to raise a staggering $289.5 million. Now you might be asking, why are they dumping their bags? Well, they aren't just cashing out to walk away. They're directly reinvesting those proceeds into massive data center expansion and AI infrastructure. They are actively pivoting toward the highly profitable, high-performance computing sector that the AI boom demands. And this really brilliantly highlights a massive paradigm shift. Large-scale miners are absolutely no longer just passive holders of Bitcoin. We need to start looking at their Bitcoin treasuries like an energy battery. Think about it. They mine and store value when crypto is the best use of their electricity. But when the AI computing sector becomes way more profitable, they discharge that battery by selling their Bitcoin to fund a pivot into AI infrastructure. It's an incredibly dynamic allocation of energy and capital, but for sure, it does create a consistent supply headwind for the Bitcoin market as these giant miners sell. All right, Section 3, hedging and digital scarcity. You might be wondering, how does the market just absorb hundreds of millions of dollars in miner sell-offs without totally collapsing? Well, veteran venture capitalist Tim Draper sums it up perfectly. He just renewed his $250,000 Bitcoin price target, projecting the asset's going to hit this milestone within the next 18 months. His rationale is pretty straightforward. He argues that persistent inflationary pressures on the US dollar are creating this permanent safety bid for digital scarcity among global investors. Basically, while miners are selling off to build out AI data centers, global investors are aggressively buying in to escape fiat inflation. And you can actually see this tug-of-war playing out right in the liquidity data. If you only look at the spot market, things look pretty cautious and stagnant, honestly. But right beneath the surface, the derivatives market is roaring. Bitget just set a massive $6 billion single-day record for CFD volume. That means traders are aggressively betting on price movements without actually having to hold the underlying asset. This surge proves that the underlying liquidity out there is incredibly deep. Institutions and retail traders alike are actively using these high-leverage derivatives to hedge their positions, showing a clear preference for complex instruments while the major assets just kind of remain range-bound. Section 4, closing the Wild West. Now, for the big institutional allocators to truly pour trillions into this space, they absolutely need a psychological floor. And we're seeing that floor being built right now through some very structured new legal frameworks and intense law enforcement actions. I'm sure many of you remember the infamous OneCoin scam. It peaked between 2014 and 2017, and it was just a massive global Ponzi scheme. Well, after years of incredibly complex global litigation dragging on from 2018 to 2025, we finally have a breakthrough in 2026. U.S. victims have officially been granted a new path to recover their assets. This is highly significant, guys. It's a precedent-setting case proving that international law enforcement can collaborate effectively to return funds from these global crypto schemes. The net is definitely tightening on bad actors. And it's not just historical scams being addressed either. It's physical security today. The French government actually just announced brand new legislative measures specifically targeting physical crypto kidnappings. Those terrifying wrench attacks we've seen on the rise. They are implementing expanded surveillance powers to track real-time fund movements during hostage scenarios, and digital borders are hardening too. The digital gaming sector is rapidly professionalizing. Coinplay.com just launched an all-in-one crypto-native platform, while OpenPaid released a massive new solution to mitigate chargeback fraud, which has always been a huge hurdle for getting crypto into mainstream iGaming. Across the board, all those vulnerabilities of the Wild West era are finally being patched up. Finally, Section 5, the AI beta rally. So what does all this complex technical, legal, and mining data actually mean for your market outlook today? Well, here is the defining question for May 2026. Are we entering an AI beta rally? Like we discussed, we are transitioning from simple bot transactions to highly complex, autonomous financial workflows powered by models like Claude Opus 4.7. The automation of this machine-led economy is incredibly powerful, and it's highly likely to drive on-chain volume to absolute record highs as we move into June, even if the sentiment of everyday human retail traders remains a bit on the cautious side. So, here is the exact actionable sequence you're going to want to keep an eye on today to see if we end the month on a high note. Step 1. Watch the on-chain data really closely as developers aggressively start integrating the new Claude 4.7 model into DeFi protocols. If that catches on, we jump to step 2. Keep an eye on the Bitcoin spot price to see if that permanent safety bid Tim Draper talked about can successfully hold its ground and absorb Riot Platforms' massive expansion selling. And finally, step 3. We wait to see if all these improved security frameworks and robust new iGaming infrastructures finally spark the retail FOMO needed to push the market over the edge. I want to leave you all with a final provocative thought to chew on. Will this machine-led economy eventually outpace human retail sentiment entirely? As AI agents start managing their own treasuries and executing their own trading strategies, the market forces of the future might look very, very different from the human emotions that drove the past. Thank you so much for hanging out with me today to learn and decode all these massive structural shifts. Keep your eyes on the data, stay curious, and I will see you in the next explainer.